Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 262 of the Independent Advisors Podcast, where Matt Jessup and Mark McEvely bring you everything you need to know from the past week in the world of financial markets and financial planning. I am Aaron Kramer, wealth advisor with the firm, and I'm joined by Nick Whitaker here, Director of Research. So very happy to be on the podcast with you. It's been a long time since we've done it, so I think it'll be kind of fun here.
Yeah, it's been a very long time. I think probably maybe even a year. So sorry for listeners, you don't get to see Matt or Mark today. We've got two subs off the bench. They're away on business, but hopefully this is a good one. So,
all right. As always, we'll quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts as of the market close on 7/24.
Yep. So the S&P 500 is down 0.6% month to date and up 13.8% year to date. The Dow is up 1.9% month to date and 5.7% for the year. NASDAQ is down 2.2% month to date and 15.5% up 15.5% year to date. The Russell 2000 ETF, think small caps, is up 7.4% month to date and up 8.5% year to date. The Vanguard FTSE All World ex-US ETF is up 0.5% month to date and up 5.0% year to date. The 3-month Treasury rate is sitting at 5.4, the 2-year at 4.37, and the 10-year at 4.28%. So, as we talked about last week, some action,
definitely some rotation
caps.
into small caps,
Yeah.
and with the Dow being positive and the S&P being kind of flat for the month, we're seeing some healthy rotation.
Oh yeah,
outside of the big heavy hitters, right? So,
and I'm gonna dive deep into that on.
I won't steal your thunder. That's
so,
awesome.
Yeah, that'll be fun. We'll dive into those details a little bit more for everyone.
Okay.
Scooting along to the big headlines and current events, there's no shortage of things to talk about from the past week.
There's really a lot going on in the U.S. and in the world.
The past 2 weeks. On the 19th, CrowdStrike had a technical update that created a bug that infiltrated Microsoft's operating software, which triggered what everyone was labeling a global IT outage. I'm sure people read about it.
Mm-hmm.
That was pretty big news.
Resolved fairly quickly, though.
It was resolved pretty
very
quickly,
impressive,
which was
in my opinion.
Yeah, which was encouraging. Over the weekend, Biden dropped out of the presidential race. Obviously, big news. Yesterday, we had a big tech sell-off that sent the S&P 500 to the worst day since December of 2022. It was kind of a disappointing start to some of the mega cap earnings. Has fueled a little bit of AI concern. You could say that the hype has maybe been overbought and overblown.
Yeah, a little bit overbought potentially, and I think that that makes some sense. The market was especially in those areas had run up so much, so it's there's always going to be some healthy rotation. So it's not necessarily a bad thing from a market breadth standpoint.
Absolutely, and some profit taking. So the Nasdaq 100 was down 3.5% yesterday, so a pretty big move there, and a lot of that came from disappointing earnings from Tesla and Google. Tesla was down 12% after a relatively disappointing earnings report. There was earnings miss and a decent drop in their operating margins, as well as the robotaxi delay. So another kind of big pullback for them.
Right.
And then at the same time, Google reported they slid 5% after higher AI spend than analysts were expecting, and YouTube advertising revenue also came in below expectations.
Yeah,
so
looks like they're going all in on AI, which you can kind of a double-edged sword. It's not great to miss earnings, but it sounds like they're putting a lot of capital to use in those projects. So it's kind of interesting.
Absolutely. And then also yesterday, and I'm sure this is going to be in the news a lot more, but to throw fuel on the fire from yesterday's sell-off, you had political uncertainty that that was thrown into the mix. Some of the polls were showing that Vice President Harris was tied with former President Trump, while others have her trailing with a margin of error. So, on top of all the other AI news and earnings and everything else going on, let's throw some political angst onto the situation. So, a bit of a defensive
We've
rotation.
talked about this probably before, but you know what I don't trust is a poll.
Yeah, yeah.
I don't trust a poll. It's select data, so I don't know. But that's a great headline that kind of falls right in with one of my topics. So if you're all right with it, I'll take it over to tweets, articles, and research from this week.
Yeah, absolutely.
And I will kick off my few topics, and then I'll send it back to you, okay?
Fantastic.
All right. My first item is a X post by Michael Kitsos on 7/22, and it's the comparison. He tweets the Tax Cuts and Jobs Act impending expiration, which is set to sunset in 2025, raises the importance of planning for clients or for your own finances that will be impacted with the potential change in the sunset of the Tax Cuts and Jobs Act. So for listeners that might not be familiar, the Tax Cuts and Jobs Act was enacted in approximately 2017 by the Trump administration, and it basically rolled back or increased the standard deduction for many, pretty much everyone. So the standard deduction is basically how much you can immediately kind of write off or deduct from your taxes before even filing, okay? So there's kind of four, he links an article or a blog post that he has, and I just wanted to highlight kind of the four major changes and how this would impact, taxable income calculation for a lot of people. I love his little, chart here on the taxable income bracket. So other than I'm trying to say here is the standard deduction rolling back, there was also a slower scale in the tax rate. So that's what he's showing in the chart is basically the tax rates as they stand right now goes 10%, 12%, 22%, 24, 32, 35, 37 at the highest. With the sunset of the Tax Cuts and Jobs Act, that tax rates would be kind of a higher scale. It would be 10%, 15%, 25%, 28, 33, 35, and then all the way up to almost 40. So outside of the standard deduction going away, the tax brackets are actually a little bit higher. So the four major changes, and I think this is important for tons of people to know, is the standard deduction, which in 2024 was $14,600 for single filers and $29,200 for married filing jointly. That would be reduced in half, which would go to $7,850 and $15,750 in 2024 dollars. Okay, so for a lot of people, this is kind of it's a little bit nuanced here, but that would go away, and that would directly kind of increase the amount of ordinary income tax that you would have, right? I'll say there is a caveat with that, and we'll see, in item 3 why it's not necessarily that big of a deal. But item 2 he talks about is for taxpayers making itemized deductions, 100% of taxpayers eligible state and local payments would be able to be deducted on Schedule A rather than being limited to $10,000. So there was kind of some give and take with the Tax Cuts and Jobs Act. It made it a lot simpler because 99% of people were taking the standard deduction. If this act does sunset, we're going to see a lot more people itemizing is the big thing. So if it does go back to pre-2017 rules, you can use all of your state and local taxes to help itemize, which, again, is a good thing if you're trying to reduce your taxes. Okay. Item 3 is personal exemptions. So prior to the Tax Cuts and Jobs Act, a lot of people probably remember exemptions when you have a W-2 or a W-4. You would basically calculate, how many dependents do you have? Say you have 3 kids, you would basically be able to take $4,000 per person to reduce your taxes as a personal exemption. So Michael says personal exemptions, which allow a fixed amount of income to be exempt from taxable income per taxpayer or dependent listed on the tax return, will return after being eliminated by the Tax Cuts and Jobs Act in favor of the higher standard deduction. Prior to the Tax Cuts and Jobs Act, the personal exemption was $4,050. In 2024 dollars, it would be, indexed for inflation about $5,050, and would increase more by the time the Tax Cuts and Jobs Act expire in 2026. Yeah. So this is, when I was mentioning before that the standard deduction going away potentially, this is where, a lot of people say you have multiple kids, you'd be kind of breaking even at that point. But for single filers, you're getting kind of, it's not great for you, right? If you're single or married and don't have kids, you're going to likely end up paying more taxes.
Yeah, I was about to say, I'm looking at it from a single filer point of view, and I'm not loving what I'm seeing.
No, but it seems like this might stick around, the Tax Cuts and Jobs Act, because it does make it so much simpler for people. And, generally across the board, it, saves the lower income and average people on taxes, which is a good thing in my opinion. The last item it talks about is the Section 199A deduction for qualified business income. So this allows for a deduction of owners of partnerships, S corps, and sole proprietorships of up to 20% of the lesser of the taxpayer's QBI or the taxable income. So that would expire in 2025. So if you're a business owner, the Tax Cuts and Jobs Act was a really, really great thing for you, because it allows you to deduct a ton. So that going away will definitely impact small businesses. So just for listeners, something to be mindful of. There is no certainty whether it's going to continue on or if it's going to sunset, but the scheduled sunset is 2025. So what we shall see. So just something to be aware of. Maybe if you have your accountant, make sure they're, you're kind of talking about that, what to plan for if it does change. That would be my recommendation. All right.
Yeah, that's very interesting.
Yeah, it's and there's a lot more. These are just the big points, and it's far more complex than that. But those are kind of the biggest things that would impact the average person. Is those kind of 4 items.
Oh, I'm sure it's way more complicated, unfortunately.
Anything legislative in our country is far more complex than it needs to be.
Legislative tax codes.
It's fun stuff, right?
Yeah.
All right, I got another item here. This one's not nearly as lengthy and not nearly as boring. So it's an ex post by Ben Carlson on July 21st. I love Ben Carlson. I love all of the blogs that he posts out. He's a great CFA. He's extremely knowledgeable in the markets. His ex post says the S&P 500 hit 106 new all-time highs during Biden's presidency, with an asterisk so far from Inauguration Day, right? So he subtweets himself, or I don't know the lingo anymore. I'm getting old, I guess. But
you're not talking to the right guy about picking up on the lingo.
He replies to himself and said all-time highs by other presidents. Trump 148, Obama 127 all-time highs, Bush 9, Clinton 248 all-time highs. So he says the stock market doesn't care who the president is. And with those news headline, I would 100% agree. The market it's not necessarily impacted by who's in office. So historically, the market has done well no matter which party's in the office. I always try to remind clients and, listeners of this is that from the market standpoint, it really doesn't care who's in office, right? It cares what are earnings reports, what is EPS growth, right? It cares, are these companies continuing to grow their earnings and be profitable, right? What's the outlook, right?
What's the macroeconomic
Can it
situation?
be impacted by legislation? Absolutely. But the market's forward-looking, and I just think this is a great kind of piece of data to show that, sure, the election can have significant impact on our U.S. economy, but from the market standpoint, the market can do great no matter who's
regardless
in office.
of the political party that takes charge. The important thing I'd throw on there is, and I 100% agree with what Ben's saying here and everything that you just said. Heading into the election, we'll expect to see some volatility, and I think a listener could say, well, if there's volatility and the market's moving around prior to the election, then the election has to impact the market. Yes.
Short term.
It's more about it's more about the market. Again, the market, like you said, is always forward looking. So it's more about the market trying to figure out what does the next 4 years look
trying
like?
to gauge.
What does it look like? Will there be major policy changes? The market's trying to pivot, but once the script is written, so to speak, and the market can have a little bit more understanding of what the future looks like, then like Ben's pointing out here.
Yep.
I don't want to say it doesn't matter, but the stock market is resilient,
right?
is resilient
Sure.
to political landscape. It's like you said, it's earnings, it's macroeconomics, microeconomics, it's all of
Absolutely.
it. So.
Okay. Last thing I got for you here is more IRS regulations. Fun stuff. I'm really bringing the fun for the listeners today. This is an ex post by Michael Kitsis, another great certified financial planner, great advisor, really, really smart guy. He links, and this post was on 7/24. He links one of his blogs to this post, and the post says, in its new final regulations, the IRS confirmed the requirements for the non-designated beneficiaries to take RMDs annually. The 260-page document offers regulatory guidance where new rules for beneficiaries apply. So what I wanted to do is, he links his article here. I wanted to highlight a really great chart, it's called the IRA family tree is what he calls it. And then it's I wanted to highlight the intra 10-year RMD rules that are not required until 2025. So basically, what has happened is when someone inherits a tax-deferred IRA or a Roth IRA, they basically have 10 years to deplete that account from the passing of the decedent. Okay, so what just came out is the IRS rules. It was somewhat unclear or extremely unclear for advisors and for people that have inherited these accounts is whether or not they need to take annual required minimum distributions or a certain amount out each year prior to the end of that 10-year, right? So what this rule is saying, it was a big cliffhanger, and advisors have been waiting for like 3 years to know what's really going to happen. So I'm happy to have some clarification on this, which is huge. But it's basically saying if you are a non-eligible designated beneficiary, meaning you're not a surviving spouse, you're not a disabled child, you're not chronically ill, you're not within 10 years of age of the decedent, you're not a minor child, and you're not a special see-through trust, you basically have to take a stretch RMD based off of your life expectancy throughout those 10 years when you inherit the account. So And this family tree is really helpful for listeners if you've inherited an account or someone that has. It's extremely interesting to see. So basically, to sum it up, if the decedent had started RMDs, say they were 70 and a half years old at passing or 73 years old, and they had started required minimum distributions from their IRA or retirement account, if you inherit that and they had those RMDs already started, you are required, starting in 2025, to take required minimum distributions annually up to the year 10, where it has to be completely distributed. So if the decedent hadn't started RMDs yet, so say they were younger and they hadn't had the required minimum distributions, the 10-year rule only applies, meaning you could technically wait all those years
do lump sum.
At a lump sum at year 10. Exactly.
So just to clarify, on the other situation where you're basically having to continue the RMDs, do you have to basically take that 10 years and like prorate it evenly across the 10 years, or do you not? So you take the RMD consistently, and then maybe there's like a little bit left at year 10.
There could be a lot left at year 10.
Yeah, a lot.
So how the stretch rules work is a stretch basically means it starts with your life expectancy table. So if you're 25 years old and you inherited an IRA, it's going to be a very, very small amount. So, with that 10-year rule, it could make sense for someone to consider, hey, maybe I need to take more than what the required minimum is. That's just what the federal government wants to see you take out, right?
Yeah. And that depends on.
It depends on
if
the
you need the money,
right? Your tax brackets. It depends on a lot of.
If you want the money to grow, because that's another great benefit of it.
Yeah, it's tax deferred, right?
Yeah.
So the concern is you get to year 10, depending on the size of the account, you could throw yourself into a massive tax bracket, right? Because it's all ordinary income, right?
Gotcha.
So this is just, these are the minimum rules. Again, this is not a recommendation on what you should do. It's just you have to be aware of these rules, because if you miss a required minimum distribution, you can be hit with some pretty heavy penalties. So
yeah, it's a big penalty.
It is. They changed it. It used to be like a 50% penalty.
Yeah,
it got moved down to a 25%
Okay.
penalty.
Yeah.
So just be aware that, if you did inherit an account and the prior owner was taking RMDs, you have the 10-year rule and the stretch rule for required minimum distributions. Okay. So advisors have been waiting for this news for a long time. So,
Yeah, if listeners are curious and want to look at this is a great chart.
it's super.
It's a very
the
helpful
chart's
chart.
very easier to see versus my explanation.
I mean, it helps. I definitely need your explanation, but having your explanation and the visual chart in front of me is really helping me put it all together. So it's great.
No, the chart's good. The chart's very helpful. All right. Any other comments on that stuff, or you're right if you kick it off to yours?
No, I feel good about that. So my first piece is on a little market rotation, like we were mentioning earlier.
Absolutely.
I know you guys talked a little bit about this last week. I've shown some reversion charts in the past, some graphics, and then also some tables. We're going to do tables today because I think it's a little bit easier to see with the amount of data that I'm going to throw up for listeners. So I really just wanted to dive in and just discuss a little bit about this, and just kind of highlight what's going on. The 3 periods that I chose to study reversion are year to date up until July 10th. The second period is July 10th to July 16th. And the third period is July 16th to July 23rd. Why did you pick those periods,
why did you
Nick?
pick this?
Why would you do that? I picked those periods because that's where we saw small caps really begin to take the wheel and outperform. And so that's kind of what sparked the
That's your trigger.
The thought.
Trigger for those dates. Okay.
And I just wanted to look at it a little bit closer. So that's the reasoning. Starting on the 10th, small caps really started to take the wheel. So just kind of giving a brief overview on what was going on. On the 5th, we had the big jobs report that showed the jobs numbers were softening. And then over the weekend, the following week, was the 9th and 10th, we had Fed Pal testimony. So this is the 9th and 10th. And then remember, the 10th is when the small caps really started to pick up. And then that whole week was a series of events and economic data and news that I think benefited that whole story of the rates, the rate cut, definitely happening in September, as the market thinks.
And then we talked about that
in
last podcast. It's basically 0% odds that the market is expecting no rate cut. Right?
Exactly. And
0% is pretty solid confidence from the market.
Exactly. And so I think around that time, the 10th, when small caps started to take out, and the next day CPI inflation cooled in June. Then big banks kicked off earnings. PPI accelerated a little bit. Then the 16th, retail sales came in a little stronger than expected. And then 17th, you had a bit of a market pullback with some concerns about semiconductors. And there's some limits, some headlines around the Biden administration and tighter export restrictions. So, that helped kind of some profit-taking sentiment from some of the mega cap stocks, which again is contributing to that. So one of the things I wanted to point out here, and we'll throw this chart up, is you can notice the first kind of rotation here from the 10th to the 16th. Obviously, small caps pick up. The small cap is that S&P 600. So those are the small caps. The S&P 400 is your mid caps. Obviously, the S&P 100 is the large, the mega caps, the big guys. So you could see the mega caps. A lot of that's led by the Magnificent Seven year to date, or I should say year end through the 10th, really leading the market at 23%. And then you see that, six day window where we have that rotation. But what I also want to draw your attention to is if you look down to the sector section, you can see, volatility picks up a little bit. That's fine. 2%, that's 3%, 2.6 for the VIX is not massive. But the sectors you see, healthcare's up, consumer cyclical a little bit, industrial is 5.1%, financials 3.8, natural resources 4, real estate 5, energy 3.3. So that's very much a cyclical kind of value-oriented rotation.
Well, and especially, I know financials is a majority of small caps, right? Was it half, something like that? So
yeah,
it makes a lot of sense.
It's a very big piece of it. And so I wanted to point this out in that window, after we get, a little bit more confidence, or after the market gets more confidence that the first rate cut is coming in September, you see this profit taking from the Magnificent Seven and from the AI story, and you see it what is 100% categorized as, I think accurately categorized as a healthy rotation into cyclical value, small cap, kind of moving down the chain a little bit. The next period, which is also interesting, the 16th to the 23rd, again, reminder that 17th, the market pulled back. There's a lot of profit taking following the tighter export restrictions for semiconductors, on semiconductor equipment going to China. There was a headline about that. That contributed to a little bit more profit taking and a bit more of a stronger pullback, right? Then we had the global outage, and then Biden dropped out of the race. And then yesterday we talked about all the political angst and the big cap earnings that weren't exactly what we wanted to see. And you see the rotation looks different. It's no longer a continued push into these value-oriented sections of the market. It's more what we would call a defensive rotation.
Yeah, yep.
So you see the consumer
Real
defensive
estate,
and the utilities and real estate are leading the market in that.
It's more of a risk-off trade.
It's more of a risk-off trade. Now, these are very small windows, right? We're talking like five trading days. But the reason that I wanted to point it out is because of the environment that we're in, there's going to be angst in the market over valuations, over the concentration in the S&P 500, gains year to date with the mega cap stocks, Magnificent Seven. You throw in the political landscape, you throw in mixed earnings releases across corporate America that we're likely going to see over the next few weeks and months. All of these stories aren't going to go away anytime soon for the next few weeks, really leading up into the election.
I would say into October, yeah.
And so I wanted to point out these two kind of types of rotations that we've had, because it's not going to shock me if over the next few weeks we have these kind of back and forth where, you see kind of bigger, faster swings, a little bit more volatility. You'll see the VIX pick up. So in that third column, 16 to 23rd, you see the VIX pick up 11.6%, a little more volatility, a little more rotation, bigger defensive. The treasury yield was steepening a little bit as people are buying the front end of the curve. So I think you're going to see these types of rotations. And so I just wanted to point this out, kind of show some listeners a little bit.
With some great data. I love it.
Yeah. And this is, by the way, all this data is coming from YCharts. It's just proprietary data that we have in-house and obviously move things around and play with dates. But I just point this chart out. I wanted to point this chart out and just explain to listeners that these types of rotations, I believe, will happen.
Yeah, I think it'll continue.
And
I would say, as earnings season continues, I would see a lot of buy the rumor, sell the news. Is that a company could still have a good earnings report, and it would not surprise me if they sold off. Right? Yeah. It's just that I think that rotation is coming and is going to continue to. So, listeners, don't be surprised if quality names are getting not getting a bid in the short term,
having a bit of a pullback.
Yeah, absolutely.
And also, I wouldn't be surprised if you have a few buy the dip days as well. Yeah. Where, some of these mega cap names maybe get a little oversold.
Some people that have cash on the sidelines that haven't found a discount year to date, right?
Yeah. And maybe get in just to kind of get a solid position. A lot of the market is not going to liquidate the Magnificent Seven. That's not how the market operates.
So much cash
index
on the
money
sidelines right now too, with yields being up. I mean, there's so much cash out there because it's been easy to get 4 or 5% in a money market or in a treasury, right?
Yeah.
So, I think it'd be a lot to buy the dip coming over the next 2-3 months.
Yeah, we'll see. There's obviously a lot going on in the markets. We're kind of peak earnings season right now. We'll have some more big tech earnings at the end of next week. So, just be prepared for some volatility in some of these rotations. Again, these are very small windows, so not crazy reversion trends, but interesting nonetheless.
Yeah, if you look at any short date range, it's going to look scary and volatile, right? Either way,
it can look strange, So that leads me to my next piece, which is taking another look at that small cap strength that we just talked about. This is a X post, not a tweet. I'll have to edit my notes here. It's an X post.
It's hard to break that habit, isn't it?
Yes. From Michael Cantro. He's the chief investment strategist at Piper Sandler. This is a tweet from yesterday. He says the following: S&P 500 gains year to date have come from a near 50-50 split of improving EPS expectations and multiple expansion, while over 90% of small cap S&P 600's gain is from multiples. Earnings season will be interesting. So what he's saying here is basically looking at the price change of the S&P, right? Mm-hmm. And the price change, you have earnings, then you have the earnings multiple, and it's basically that multiple expansion versus, earnings expansion. And he's saying, 50 of the S&P 500 it's about earnings, about half of it is earnings, sure. Half of it is multiple expansion. Whereas the small caps, most of it is multiples. So we haven't yet seen the earnings to justify the move multiple. In the price. And Matt mentioned last week that these small caps can move very quickly in both directions. And this was an excellent chart to kind of follow up on his point and say, yes, like 100% they can. And if earnings for the small cap group in general, and obviously that's a big group and it's a lot of generalization there, but let's say earnings come in much weaker than expected, it's very possible that you see a violent move to the downside. Sure. And that will be an example where maybe the market comes back in and they buy the dip on the Magnificent Seven.
Sure.
So we're in the midst of a lot of changing narratives and landscapes for the market and kind of pivot points, I think, which is another reason why this earnings season will be so interesting.
Yeah, it's pretty vital for the next several months.
Why I think you can expect some higher volatility, some higher day-to-day swings, as we've seen just in the past 2-3 weeks. But we'll throw this chart up here. It's a pretty cool chart.
Great chart.
Yeah, give you a little bit more. That chart is from Piper Sandler, which makes sense because the tweet was from, or the X post was from their chief investment strategist. So, you have any comments on that before I move to the last post here?
No, I think that's great. Small caps are definitely volatile for a reason, but no further comments. I think what you're saying makes complete sense.
Yeah, we'll see what happens. My last piece here, and my pieces are kind of all tied together here today.
There's a good theme.
There's definitely a theme. That was unintentional. It just happened. Then my next piece is on earnings growth across the S&P 500. This is a tweet. This is an X post from Markets and Mayhem, also from yesterday. They say the following: we may finally see earnings growth expansion to the inglorious S&P 493.
That's really funny.
In Q2. First off, that is a hilarious statement. The inglorious S&P 493. That's really fun. I applaud him for
that's some good
his wordplay. And then he has a chart here. This research is from Bank of America's Quant Desk. They have great stuff. And it shows the Magnificent Seven earnings growth from quarter over quarter from 2020 all the way up through earnings growth projections through 25. They show the Magnificent Seven and the inglorious 493. And you can see this quarter, the market is expecting earnings growth to come back to the 493 group. Sure. And you can kind of see growth expectations leveling out a little bit.
Interesting.
Very interesting chart. especially in context of the rotations that we discussed and the small
I
cap
think it makes a lot of
expectation.
sense.
And so when you put all this stuff together and you look at it, you're like, oh, okay, that makes sense why the market was kind of rotating a little bit more into the value, and you're starting to see that. But then you get some angst in the market, and you go a quick buy the dip for the Magnificent Seven. So you're going to see kind of those knee-jerk reactions a little bit, I think.
Absolutely. Oh, and it's interesting. If you kind of look at this chart, we had a bear market in 2022, right?
Mm-hmm.
So those so let's call them smaller companies, not as mega cap, right, aren't quite as resilient as trillion-dollar companies, right?
Oh yeah.
So it's taking them a little bit longer to recover their earnings and grow their earnings. So
takes them longer to get those engines fired.
Right. Especially when they're not getting as much money flow and as the really big heavy hitters. So
and they can be more and a lot of times it might have to be more conservative as well.
Absolutely. No, that's a great chart. I think it would be very good and very healthy to see that. I think it might lead to longer term, kind of more consistent, solid performance of the S&P 500, where if most of the companies are up, even half of them are up for the year, right? You're not going to see those bigger moves in the in the S&P 500 growth.
Market breadth is a good thing.
Absolutely.
That's what we want to see. As fun as it is to talk at length about the Magnificent Seven, I would like to not have to use the inglorious 493.
I would like to see the glorious 493, right?
Yeah. That's what we want to see. We want to see market breadth. So I think these are all good things for the market. Just going to be a little bit of maybe pain in between.
Sure.
For listeners, so just kind of expect that, and hopefully that helps.
Some choppiness, I would say some choppiness coming up here for sure.
Yeah. So I know we have Taylor's going to jump in on the financial planning topic here. So thanks, listeners, for having me.
Thanks,
always.
Nick. You're great. Welcome, Taylor.
Hey, it's good to be back.
Absolutely. All right. What do you got for us today?
So today I'm going to be talking about a type of retirement plan that is specific to business owners or self-employed individuals.
Okay.
And the article I'm going to be referencing, it is from New Retirement, and it's called Solo 401ks, a massive savings opportunity for the self-employed. So basically, a solo 401k, it's just like a standard 401k,
right,
for the most
absolutely.
part. But it is, again, designed for business owners with no employees. So you actually can't contribute to a solo 401k if you do have full-time employees, but the IRS does make one exception to that rule, and it's if your spouse works for your business.
Perfect. Yeah, I think these plans are nice. Not to jump ahead of you, but they're really nice because they're simple to set up. There's not a lot of expense in running them like a traditional 401k. So, continue.
Yeah, and they're quite a bit more flexible too.
Yes, definitely.
There's no age restrictions, no income restrictions. I know with standard 401ks, you might have to work at the company for a certain amount of time, maybe be, a certain age. So no restrictions in that regard for this type of account. But I think the biggest advantage is really the contributions and the tax benefits. Because with the solo 401k, you're basically acting as employee and employer. So just as a reminder, for 401k contributions, you can contribute up to $23,000 every year. If you are 50 or older, you can put in an additional $7,500.
Yep.
But since you're acting as employee and employer, you can do an employer contribution up to 25% of your total compensation.
Wow, that's great. I mean, that's a huge amount that you could, defer on taxes, especially as a small business owner or a business owner. That's probably a lot of what they're looking for, right?
Oh, yeah, because you can deduct the cost of the plan and then again, those employer contributions. So really between employee and employer, you can put in around $69,000 per year.
That's huge, especially if you're a business owner that, you do have a, significant income, being able to defer that and, being able to save for retirement. If you're a solid earner, the minimums of 401ks and IRAs can be kind of limiting for your retirement, especially if you're, higher net worth or trying to be, replicate a higher income in retirement. The lower limitations of certain plans can kind of limit you. And it's nice to be able to have that, tax deferred savings for the long run. So I think that's huge. It's awesome for single, sole employees or sole business owners.
Yeah. No, the IRAs definitely are restrictive. But, it's nice that since you are the employer, you can choose how much you put in, because with a standard 401k plan, you don't have control over how much your employer's putting in. They choose that match, and some
Right.
are really good and some are pretty low.
Yeah. And there's some that have none, right?
Yeah. And it's also important to keep in mind that if you do have a day job and you're self-employed, maybe you have a solo 401k and a 401k through work, these contribution limits do apply to all plans.
Yeah, you have to look at both of them combined, right? So you can't contribute $69,000 to your solo, right, and another $23,000 to the one through your other employer, right? Okay.
Yeah, that'd be nice.
Yeah.
But, and then just some tax benefits with the solo 401k is you can choose between the traditional and the Roth 401k. Whereas, a standard 401k, a Roth might not be an option. It's really just up to the employer. So again, with the Roth, you are paying those taxes up front at your current rate, and then you receive tax-free income when you retire. Whereas your traditional 401k, those are deductible on your tax return and taxable later on. And again, you can deduct the cost of the plan and the contributions.
Awesome. No, I think that's a great topic. I'm glad you brought that up. And I think that kind of is a good thing for business owners to think before, October. October is kind of the cutoff. If you do have a plan that you want to set up, I think it has to be in effect by October before you can start it for the next year. That's just one little caveat rule that, the IRS doesn't want you setting up a plan in December just to, save a bunch of taxes right at the end of the year. So
Right.
Definitely something for, business owners and, maybe a sole practitioner or whatever your industry is. Definitely something to think about if you're trying to save a ton on taxes and save a bunch for retirement. It's a great option.
Yeah, there's not a lot of options out there, but I do think this is probably one of the better ones.
Absolutely. And I think they're pretty quick and easy to set up, and the annual expenses shouldn't be too bad, right? If it's one person, you're not going to have an audit like a traditional 401k plan might. So I think it's, they're simple, easy, and high contribution limits is awesome. Okay.
Yeah.
Any other thoughts or?
No, I don't think so. I just, highly recommend these types of accounts if maybe you've never heard of one before, you are self-employed, maybe you've just been using IRAs.
Right.
This would be a great addition.
Definitely. All right. Any thoughts on the market or anything else that you have? I think the only thing that I would, just kind of preview to listeners from my end is that, be prepared for some continued volatility in the market, especially with the election coming up. Like Nick mentioned, there's going to be, I think, some healthy rotation into some different areas of the market outside of the big heavy hitters that we've seen so far this year. So that's the only thing I have. Anything else you have?
I thought all the research you guys had today was really interesting. Especially some of the all-time highs for, past presidents. So I think you guys covered a lot of good data today.
All right. Well, thank you for listening to episode 262 of the Independent Advisors Podcast. We will be back with you next week for episode 263.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.